Imagine a world where money is, well, it's the most expensive it's been in years.
Right, yeah.
Massive institutional landlords are literally defaulting on their commercial loans. And yet somehow, leasing retail space in Dallas is harder than getting past the velvet rope at an exclusive nightclub.
It really is wild when you put it like that.
Today, we are unpacking a market that has just completely broken the fundamental laws of economic gravity. You know the old rules.
Oh, absolutely. They're supposed to be super predictable.
Exactly. When interest rates skyrocket and loans get harder to secure, development is supposed to slam on the brakes. Tenants pull back, and the commercial real estate market, cools off.
That's right. I mean, high cost of capital is basically nature's cooling mechanism for an overheated economy. It's supposed to freeze the market across the board.
But when you actually dig into this massive stack of commercial real estate news we've gathered from late March and early April of 2026, it feels like someone just turned off the gravity entirely.
Yeah, totally.
We're staring at a complete paradox.
A historic paradox, really. We are witnessing immense systemic stress in capital markets and, well, traditional office sectors.
Right?
But that's sitting directly adjacent to an incredibly resilient, record-breaking retail environment. And honestly, nowhere in the country is that contrast sharper or more lucrative than in Texas.
Exactly. And making sense of that paradox is the entire mission of today's deep dive. So if you're trying to figure out what these national macroeconomic shockwaves mean for your investments, you are in the exact right place.
We definitely have a lot of ground to cover.
We do. And we should mention this deep dive is brought to you by Eureka Business Group. They are the premier authority on commercial real estate brokerage in the Dallas-Fort Worth market, specifically specializing in retail.
They really know that market inside and out.
They really do. And our goal today is to connect the dots from the massive national capital crunch all the way down to the physical storefronts in DFW to show you where the opportunities are actually hiding.
It's the perfect lens for this, honestly, because before we can talk about who is leasing a physical storefront, you have to understand the money that is or isn't building that storefront.
All right, exactly.
We have to start with the macro financial reality, which is undeniably strange right now.
Okay, let's unpack this because the financial numbers right now are pretty brutal. The 10-year Treasury is hovering around 4.31%.
Yeah.
And depending on your loan type, commercial mortgage rates are starting at 5.38% and range all the way up to a punishing 12.75%.
Which is just astronomical compared to a few years ago.
It is. And because of that, we're seeing this really alarming spike in CMBS delinquencies.
Yeah, we should probably clarify that term for anyone not deep in the weeds.
Good call. So CMBS stands for Commercial Mortgage-Backed Securities.
Right.
Basically, they're the massive bundled loans that finance skyscrapers, malls, and hotels.
Right.
Those delinquencies just jumped 41 basis points to 7.55% in March 2026. That is the largest single monthly jump we've seen since May of 2023.
And you really have to dissect what's actually driving that 7.55% delinquency rate.
What's underneath it?
Well, the underlying data shows it's overwhelmingly driven by distress in the lodging and office sectors. But make no mistake, the stress of that expensive capital is completely indiscriminate.
Meaning nobody is immune to it?
Exactly.
Yeah.
Even healthy cash-flowing retail is feeling the pinch of this financing environment. For example, Brookfield's GGP just had to hit pause on a CMBS refinancing package for 2 of its enclosed malls.
Wow.
Yeah, and one of those is the Willowbrook Mall down in Houston.
Which brings me to the exact contradiction I am struggling with in these reports.
I think I know where you're going with this.
Well, if money is this incredibly expensive, and these bundled loans are stressing out to the point of a 3-year high in delinquency jumps, and even massive institutional players like Brookfield are pausing refinances,
Right.
how on earth is retail defying the gravity of this capital crunch? Because the National Association of Realtors is reporting that retail is currently the tightest major sector out there.
Yeah, the tightest sector.
Boasting 2% rent growth, but also negative net absorption. Wait, stop right there. How can a market be tight if absorption is negative? I mean, that sounds like a total contradiction.
It does sound completely backward. But if we connect this to the bigger picture, it's actually a fascinating statistical illusion.
An illusion? How so?
So negative net absorption usually means a market is dying, right? Because more total square footage is being vacated than leased.
Right, that's the standard definition.
But here, the negative number is entirely caused by massive, isolated big box bankruptcies. When a giant like Bed Bath & Beyond goes dark, It dumps hundreds of thousands of square feet of vacancy onto the ledger all at once.
Oh, I see. So it skews the aggregate data.
Exactly. The aggregate square footage looks negative because of a few dead whales.
Mm.
But if you look at the smaller inline store spaces, like the 2,000 to 5,000 square foot spots, tenants are fighting tooth and nail for them. The actual leasing velocity for standard retail is intensely competitive.
Wait, but if landlords are making a killing on rents right now because of that intense competition, wouldn't developers just find a way to finance new builds anyway?
You would think so.
Right, because greed usually finds a way. Why aren't we seeing cranes everywhere building new strip centers?
Because the math is just an immovable object right now. The cost of capital is indiscriminately high. Just think about the equation for a developer today.
Okay.
With materials and labor costs where they are, combined with construction loans sitting at 9 or 10%, practically no new commodity retail space can be built profitably.
Wow, so the pipeline is just dead.
It's virtually frozen.
Mm.
So because new supply is artificially choked off by the capital markets, the existing retail inventory becomes incredibly valuable.
That makes a lot of sense.
Yeah, high interest rates are essentially acting as a protective moat around existing retail centers. The tenants have nowhere else to go, which hyper-protects the landlord's cash flow.
That is wild. The high cost of money is literally the thing keeping current retail properties so valuable. And if retail is the tightest sector nationally, the data out of Texas, and specifically Dallas-Fort Worth, shows a market that is just breaking the sound barrier.
The metrics out of Texas right now are genuinely historic.
Yeah, according to a recent Weitzman report we reviewed, the DFW retail market achieved a record overall occupancy of 95.3% at year-end 2025.
That's a staggering number.
It is, and they project it to tick up even higher to 95.4% in 2026. Austin is sitting at 97% occupancy, and Houston is hovering right at similar levels.
And just to put that in perspective for everyone, anything over 90% in commercial retail is generally considered a highly constrained, landlord-favorable market.
So at 95.3%, you are functionally full.
You're completely maxed out.
I like to picture the DFW retail market right now as this high-stakes game of musical chairs. Because of that capital crunch we just explored, developers have completely stopped making new chairs. The music is playing, the chairs are super limited, but suddenly, 34 massive new grocery stores just confidently walked into the room demanding a seat.
That is exactly what's happening. That Weitzman report explicitly tracks those 34 grocers in the works for 2026 and 2027 in DFW alone.
It's unbelievable.
We're talking about aggressive regional expansions from heavyweights like H-E-B, Kroger, Sprouts, and Walmart.
And they aren't just taking, small neighborhood corner spots. These are massive, complex footprints. Are investors actually stepping up to fund these acquisitions given the interest rates?
They are, but the capital's highly selective now. Major money is still flowing heavily into the region, though.
Give me an example.
Well, we just saw Dallas-based Dolphin Industrial acquire a 1.4 million square foot portfolio for $207.5 million. And that had a heavy concentration right in the Dallas area.
Wow.
We're also tracking family offices aggressively stepping in. They're making opportunistic all-cash bets where traditional institutional capital might be sidelined by debt costs.
But what is the fundamental driver here? Why are these massive entities betting hundreds of millions of dollars on a market that's already functionally full?
Because the demographic fundamentals guarantee long-term demand. It's just math. The sheer population growth and the relentless corporate relocations to the Sun Belt are acting as an unstoppable engine for retail.
Oh, like the Apollo Global Management news.
Exactly. Take Apollo, for example. They are a firm with over $900 billion in assets under management.
That's billion with a B.
Billion with a B. And they're currently weighing Texas as a potential site for a massive new headquarters.
Incredible.
When corporate giants bring thousands of high-paying jobs to DFW, those employees need groceries. They need fitness centers. They need restaurants.
The demand is just baked into the population migration.
100%. And that's exactly why navigating this environment requires a hyper-local expert like Eureka Business Group. You really need someone who knows exactly where the few remaining chairs actually are before the music stops.
Absolutely. So the space is historically full and the demand is baked in. But when we peel back the curtain on the actual tenants, who is actually signing these leases?
That's the million-dollar question.
Because the anatomy of the modern retail tenant is shifting dramatically. Here's where it gets really interesting. We're seeing international brands heavily target the U.S. right now.
We are.
Established Asian retail brands like Miniso, Daiso, and Shergi are aggressively chasing American square footage, and they're adapting their store sizes and merchandising to fit both urban street-level retail and sprawling suburban shopping centers.
And we're seeing an equal amount of aggression on the domestic front, too, mostly through strategic consolidation and some really creative land grabs.
Like the Burlington move?
Yeah, Burlington just went on an absolute lease-buying spree. They took over 45 former Joann store leases directly out of bankruptcy court.
That is so smart.
It really is. They aren't building new stores. They're just assuming the leases to rapidly expand their footprint on the cheap.
We also saw Bed Bath & Beyond swoop in and buy the Container Store for $150 million to expand its footprint. And interestingly enough, the Container Store has its headquarters right here in Coppell, Texas.
Yeah, a nice local tie-in there.
But beyond traditional goods, the experiential side of retail is just exploding. Concepts like Slick City, which are these massive indoor play parks, are gobbling up former big box storefronts.
Right, because the spaces are just sitting there.
Exactly. Even IKEA is adapting its model. They're opening a 63,000 square foot small format store at the Shops at Park Lane in North Dallas. I have to ask, though, are landlords just swapping one big box for another, or is the fundamental definition of a good tenant changing?
What's fascinating here is that the calculus for a good tenant has completely transformed. Landlords are no longer just looking at a traditional credit profile, checking a box, and walking away.
What are they looking for, then?
They are prioritizing foot traffic generation above almost everything else. In a world where a consumer can buy almost any commodity on their phone, the physical retail space has to offer an experience or a service or necessity that simply cannot be digitized.
That makes perfect sense.
That's exactly why you see indoor play parks taking over former grocery boxes or high-end Asian lifestyle brands moving into standard suburban centers.
So landlords are acting less like passive rent collectors and more like, I don't know, Disney Imagineers.
I love that analogy.
They have to place the anchor attractions strategically to ensure people are forced to walk past the smaller, high-margin shops.
That is the perfect way to look at it. You're basically engineering the gravity of the center itself. And this is where the specialized brokerage capability of Eureka Business Group proves so invaluable.
Because it's not a plug-and-play situation.
Not at all. You can't just drop a random tenant into a 95% full market and expect the surrounding center to thrive. You have to actively curate experiential and specialty tenants that cross-pollinate foot traffic. The right mix protects the shopping center's long-term viability, prevents turnover, and ultimately maximizes the landlord's yield.
But to build these massive experiential retail ecosystems, you need acres of land in areas that are already densely populated.
Which is incredibly hard to find.
Right. Where do you find that kind of acreage in DFW today? You look for the dinosaurs, you look for the dead suburban office parks?
Precisely. The national office vacancy rate just hit a staggering record of 21%.
Ouch.
Yeah. And as a direct consequence of that, office-to-residential conversions are up 28% from last year's already record-breaking levels.
We have a perfect local example of this transformation right in our backyard. Over in Plano, Rosewood Property Company just received zoning approval for Heritage Creekside.
Right, the mixed-use development.
Exactly. It's a 156-acre development, and they just drastically pivoted away from their original plan of 1.6 million square feet of office space.
A massive pivot.
Instead, they're scraping that idea entirely to build 2,000 apartments and 109,000 square feet of retail and dining. And we're seeing this massive movement across all of DFW.
It's everywhere.
Central Market just cleared a key approval for a new project in Uptown Dallas. A $650 million luxury project near the Katy Trail just landed a hotel and condo brand.
Wow.
Waters Creek Village in Allen just got new ownership specifically to drive fresh mixed-use investments. Even malls in places like Santa Ana are surviving by adding residential and dining.
Are these residential and retail developments essentially cannibalizing the ashes of dead office dreams?
In many ways, yes. But it's really an evolutionary necessity driven by capital. The financial stack is basically forcing developers to reimagine the highest and best use for these properties.
Right.
Because when you have 21% vacancy in the office sector, building a traditional standalone office park is just a mathematical dead end. Retail is no longer functioning merely as a standalone asset class in these dense suburban and urban nodes.
What is it then? It has become the vital base layer amenity for these massive live work-play ecosystems.
It's a completely symbiotic relationship.
Exactly. If you're building 2,000 apartments in Plano where an office park was supposed to go, Those residents require immediate, walkable access to dining, fitness, and daily needs.
Yeah, they aren't going to drive 20 minutes for a coffee.
Right. So the retail presence validates the high residential rents you need to charge. And the residential density guarantees the retail foot traffic required to keep the shops open. It's a closed-loop system.
Okay, I see.
But building that closed loop requires immense amounts of two highly constrained resources, land and power.
Which brings us to the absolute wild cards in this whole macroeconomic equation.
Real wild cards, yes.
If you want to build these thriving mixed-use retail hubs, you need available land and a rock-solid power grid. But there are surprising political and technological forces competing for those exact same resources right now.
Yeah, there really are.
Case in point, data centers. Microsoft is currently building a 900-megawatt AI data center campus in Abilene, out in West Texas. And to give you a sense of scale on how much money is flowing here, data centers now account for 13% of the entire SSB CMBS market.
And just to clarify that term for everyone quickly, SSB stands for single asset, single borrower.
Right.
It basically means custom massive loans packaged for singular mammoth properties like skyscraper portfolios or, in this case, giant data centers.
I have to stop you there, though, because as a DFW retail investor listening to this right now, I'm scratching my head.
Why is that?
Why should I care about an AI data center being built hundreds of miles away in Abilene? What does that have to do with my retail strip in Frisco?
This raises an important question, and the answer is the Texas power grid. Texas operates on its own independent energy grid managed by ERCOT.
Right, the famous Texas grid?
Exactly. Now, 900 megawatts is an astronomical draw. It's enough to power hundreds of thousands of homes. That data center out in West Texas is sipping from the exact same finite pool of electricity that a new 2,000-unit apartment complex in Plano needs to turn its lights on.
Oh, wow. I didn't even think of it like that.
Yeah. If the grid's capacity goes to artificial intelligence, the suburban apartments don't get zoning approval because they can't get guaranteed utilities. If the apartments don't get built, the retail base loses its entire projected customer base.
So it's all connected?
Completely. 5 years ago, the only constraint on development was capital. Today, utility-scale power is the absolute bottleneck for all commercial development.
So tech giants are literally eating the infrastructure that retail developers rely on. What about the land constraint?
Well, we're seeing unpredictable government policy radically alter land use and supply chains, too. For instance, the Department of Homeland Security and ICE suddenly paused a $38.3 billion warehouse purchase plan for detention centers after recent leadership changes.
That's a massive deal.
It is. And regardless of the politics behind it, strictly from a macroeconomic view, when the government suddenly halts a multi-billion-dollar industrial land play, it distorts industrial real estate comparables overnight.
Right, it sends shockwaves through the logistical supply chain. If industrial space suddenly opens up or gets frozen, it changes exactly where major retailers can afford to put their distribution hubs.
Exactly.
And on top of that, we have the ongoing tariff situation. 1 year after the Liberation Day tariff announcement, the commercial real estate industry is still facing chronic uncertainty.
It's been tough for builders.
Yeah, we're looking at a 3.5% increase in construction costs directly tied to that policy. And this is all while the industry waits on pending Supreme Court rulings to figure out what happens next.
These aren't isolated events either. Unpredictable tariffs, massive AI power draws, and volatile government warehouse buys. These infrastructure and policy shifts dictate exactly where housing can realistically go over the next 5 to 10 years.
And housing dictates where the consumer is.
Exactly.
Yeah.
Which in turn dictates exactly where experts like Eureka Business Group will place the next dominant retail nodes. You simply cannot separate the West Texas power grid or a Supreme Court tariff ruling from your North Dallas retail strategy anymore. They are all vital organs in the exact same macroeconomic body.
So what does this all mean? If you're trying to make sense of your portfolio with this massive stack of news, we're looking at a market where capital is incredibly expensive and macro uncertainty regarding tariffs and infrastructure is running hot.
Very hot.
But despite all of that gravity pulling down on the broader market, DFW retail remains a historic, undeniable bright spot.
The playbook for success in this environment is actually very clear, even if it requires surgical precision to execute.
Right.
It requires a deep understanding of how to curate experiential tenants that drive undeniable traffic. It requires navigating the pivot toward mixed-use developments as traditional office spaces fade into obsolescence. And it requires anticipating structural supply constraints like the ERCOT grid and entitled land.
And navigating that complex, high opportunity market is exactly why Eureka Business Group is the go-to DFW retail commercial real estate authority. You need someone who can see the macro data, understand the power grid constraints, but execute on the micro reality of a 95.3% occupied market.
You really do.
But before we wrap up today, I want to leave you with one final puzzle piece from our sources that really stood out to me.
Oh, yeah. This is a fascinating structural shift to watch.
Cisco, the massive food distributor, just acquired Restaurant Depot and its sprawling real estate portfolio for $29.1 billion.
A huge acquisition.
Consider this. As inflation lingers and the cost of capital remains highly volatile, are we entering an era where major retailers and distributors begin operating as stealth real estate holding companies?
It's a brilliant defensive play, honestly. When inflation drives up the cost of everything, your rent is usually your biggest vulnerability.
Exactly. By buying the dirt and the concrete, they aren't just acquiring warehouses. They're buying financial certainty. They're fixing their largest operational cost and protecting themselves from the unpredictability of the capital markets.
A huge edge.
It's something to closely monitor as the rest of the year unfolds.
It certainly suggests that in a market defined by expensive money and constrained supply, owning the physical constraints of the market might be the ultimate hedge against volatility.
It all comes back to that economic gravity we talked about at the beginning. The high interest rates and capital costs are pulling down hard on the industry, but for those who hold the right retail assets in Texas, they're managing to pull off a spectacular magic trick. Thank you for joining us on this deep dive.